Okay, so let's start with number five this time. I always start with chapter four. All right, let's go over this, man. Just take a bunch of quizzes here. And we'll go over some multiple choice. In case where the primary beneficiary predeceases the insured, in the event the insured's death, the death benefit proceeds will be paid to the contingent beneficiary. What do you think? Yeah, yeah, right here is pretty straightforward. Sometimes they're going to ask you questions like, but this, and then they're going to say, but the primary forgot to put a contingent beneficiary. Where does the money go? Then the answer is to the estate. But right here, you know what, bro? It would be really really confusing for you or for a typical test taker if there was an answer called the estate because you're gonna be like, oh, is it the estate? Well, right here, the question is just asking straight up. Primary's not there. Primary died first. So where does the money go after the death of the primary insured? To the contingent beneficiary. It's not saying no details after that. Let's go. Which of the following statements about reinstatement provision is true? What do you think? A. Remember that reinstatement is after the policy lapses. So they're gonna have to do a insurability. The client has to be insurable. Being? With interest. Yeah, okay, this one's kind of tricky though. No, I don't think it's with interest. Damn, it is with interest. Upon the policy reinstatement, the policy will be required to pay all back premiums plus interest and may require to repay outstanding loans and interest. Well, I know the loans and interest, but not the premiums have interest. Dang. Mhm. All right, number three. Under extended term non-forfeiture option, the policy cash value is converted to, remember the non-forfeiture options? Remember, think of a broke guy, can't make payments no more, but he has cash value. Think of that. We're looking at extended term non-forfeiture option. Remember that one? Yep. Insurer has a life insurance policy that he purchased 3 years ago, and he has when he was 40 years old. He was killed in an automobile accident. They discovered that the issue was actually 45 years old and not 43, as stated in the application. What will company do? Documentation. Mm-mm. Not on death. It might get me because it's 3 years and there's a contestability period of 2 years. So it could be D2. Let's see. So it's gonna pay a death benefit, but it's gonna reduce it because he wasn't 43, he was actually 45. But it's not a penalty. It's just they're just adjusting the age. So it's not he's not getting less because of a penalty for misrepresentation or lying. It's just because he's actually they're just adjusting the age. He's actually older. So since he was older, then he deserves less coverage. What required provision protects against unintentional lapse of the policy? Unintentional. Mhm. Yes, the grace period. The dividend option in which the policy owner uses dividends to purchase a term policy for 1 year is referred to as what? Yeah, it's kind of obvious, right? Oh man. The dividend option in which the policy owner uses dividends to purchase a term policy for 1 year dividend option. Oh, we already did this one. Which settlement option provides a single beneficiary with income for the rest of their life? Remember? For the rest of your life. Yep. Good job. Remember? Straight life. Oh, dang. Bro. Straight life and single life is the same thing. So be careful on that on the test. Single life, straight life, they're the same thing. They're synonyms. That's crazy. Okay. Good to know. If an insurer continually uses automatic premium loan option to pay the policy premium, what? What is automatic premium loan? Remember over here, I mentioned to you automatic premium loan right here. Bam. Grace period. If you have cash value, automatic premium loan pays for the policy until you run out of cash value. Why is it not D? The face amount of a policy will be reduced by the automatic premium. No, the face amount is not going to be reduced. It's going to stay the same, but it's going to pay for the policy until the cash value runs out. Which of the following statements about suicide clause in a life insurance policy is true? Yep. 2 years. There's a 2 year contestability period for suicide. When a life insurance policy stipulates that the beneficiary will receive payments in specific installments for a specific number of years, what provision prevents the beneficiary from changing or borrowing the plan installments? Remember? Which one? Hey? Hmm. Dang. I don't understand this one, bro. Because it doesn't really make sense. Borrowing money from planned premiums. Because spendthrift provision protects the beneficiary's money from a creditor when the person dies, when the policy owner dies. But I guess it also does this. Pretty interesting. Which of the following components must a life insurance policy have to allow policy loans? Yes, sir. It has to have cash value because the loans are from the cash value. An insured and his wife are both involved in a head-on collision. The husband dies instantly and the wife dies 15 days later. The company pays a death benefit to the estate of the insured. This indicates that the life insurance policy has what provision? The answer is no. It's called common disaster because they died in a head-on collision, so they're determining who gets the money first, and the rule is the common disaster clause. John takes his test at 5 o'clock, so I'm gonna be here studying with him until then. Oh, come on. Hello, hello, hello. Come on. Give me a second, bro. John takes his test at 5 o'clock, so I'm gonna be here with him till 4:30 p.m. So I guess no. So don't worry about it. I'll just get something after I'm done. All right, cool. All right, so common disaster clause, submit, bam, there it is. So when two husband and wife die in the same accident, the common disaster clause kicks in to determine who died first and who died second, so that there's no confusion. But sometimes that happens. Ooh, even better. Yes. Okay. So which of the following statements about reinstatement provision is true? It permits reinstatement with 10 years after a policy has lapsed. No, it's sorry. It requires the policy to pay overdue premiums before the policy is reinstated. All right, let's keep going here. What is the advantage of reinstating a policy instead of applying for a new one? Remember we talked about this? Hmm? Yes, the original age. Next one. Which non-forfeiture option has the highest amount of insurance protection? Non-forfeiture option. The answer is extended term. Extended term keeps the same coverage as it was before. The other non-forfeiture option is reduced paid up. Reduced paid up, it reduces the coverage. So it's less. That's why it's B. Conversion is not a non-forfeiture option. Decreasing term is not a non-forfeiture option. Those are bogus answers. Remember, there's only three non-forfeiture options: cash, extended term, reduced paid up. There's only three. Which of the following policy components contains a company's promise to pay? Okay. Which of the following components of contains a company's promise to pay? The insuring clause, I believe. Yeah. If an insured dies without paying outstanding loans on his whole life policy, how will that affect the death benefit? So they had the policy active, they borrowed, let's say, $5,000 from their policy cash value, and then they died. What happens? Nope. Wait. Oh, yes, yes, yes. Sorry about that. You're right. You are right. When the insured selects the extended term non-forfeiture option, the cash value will be used to purchase term insurance with the face amount. Another non-forfeiture option question. Crazy, huh? I keep asking these non-forfeiture option questions. I think you'll see a lot of them, to be honest. My wife's bringing In-N-Out burger. You want some? You want something like a hamburger or fries or something or anything? No. You're good? Yeah, I know what you mean. These things are putting me to sleep. All right. So when the insurer selects extended term non-forfeiture action, the cash value will be used to purchase additional insurance for the face amount of equal to the original. Yeah, dude, you're gonna pass this test, bro. Under which non-forfeiture option does the company pay the surrender value and have no further obligations to the policy owner? So it just gives you back your money. There's three non-forfeiture options. Cash surrender. Yep, cash surrender. Bam. Cash out. California law requires an insurance company's dividends to be credited what? What do you think? So right there it says California law requires dividends to be credited to a policy owner's policy issued by stock companies. No. Remember, stock companies don't pay dividends to policy owners. Extended term policies on the anniversary days. No. Participating policies. Yes. Remember, on the anniversary day, provided all premiums are paying current, it's participating policies. Okay. What? Today's the 29th? Sheesh. Time flies, bro. Oops. If a beneficiary wants a guarantee that fixed period, all fixed period. Yeah, my bad. I didn't think about that. A man is injured while robbing a convenience store. He does his major medical policy handle the payment of his claim. How does his major medical? I think it's B. Yeah. For how long is an insurance company allowed to defer policy loans requests? This one, I didn't talk about it, but it's 6 months, okay? So let's say you have a policy that has cash value and you say, "Hey, I want some money from my cash value." The insurance company could say, "Awesome, I'll give it to you, but we're gonna wait 6 months." And then you're like, "What? I want my money right now." But they could defer it up to 6 months. Which is true about the cash surrender non-forfeiture option? Remember the non-forfeiture options? There's only three of them. This one's the basic one, right? He just wants his cash out.
We're heading out. Nobody else is here, so it's just us.
Goodbye.
Bye.
What do you think? Cash surrender. He's just basically cashing out. Makes sense? He's just cashing out. Where?
Did he terminate?
Yeah, he is. The policy receives the original cash. No. After the cash surrender, the insured is covered for the no. The policy remains active. No. Funds exceed. It's got to be A because of process of elimination. Funds exceeding the premium paid are taxable as ordinary income. This is like an additional extra rule. B, C, and D. See, A, if you didn't know A, you're gonna get it right because of process of elimination. Just when you're taking the test, use that process of elimination ability so that it narrows it down. Like A, I didn't even have to read it. I knew it was A because of the process of elimination. But A, what A is talking about is that is the growth of it. So for example, if you put in $10,000 in premium, but the cash value is actually more than that, which by the way, it's never the case. It's never that never happened. I've never seen one. But let's say the cash value is more than what you paid into it, then that difference, you're gonna pay interest on it because it's growth. It's gains, right? That's what that is saying. Which of the following is true about class designation? Class designation. I didn't talk about that either. But class designation basically, bro, is you're naming a group of people and you're putting them in a class. Like you're generalizing it. So basically, the beneficiaries are not going to be identified by name because they're all put in a group. Like, let me give you an example. Like if you ask me, if your wife dies, who do you want the money to go to? I'm gonna say to all my children equally. So in the class designation part is gonna you're gonna put all children equal shares. See that? Instead of putting Marina, Ruby, Esmeralda, you're not gonna put their names. It's just gonna be all of them equal shares, and that keeps it simple. Okay? So they're not identified by name. You know what? Let's go to chapter 4, man. Let's go to chapter 4 now. We hit on two on chapter 5. Let's do chapter 4. There's 10 questions on the test on this, so let's kill it right here. A universal life policy has two types of interest rates that are called what? Two types of interest rates. Nope, because it's not talking about variable universal life. It's talking about just regular universal life. Yep, that's it. Good guess. Unless it wasn't a guess.
Current part of it, the test or guess. Guaranteed is guaranteed. What's current?
Yeah, the current interest rate is like guaranteed is like the minimum. Like it's gonna give you that guaranteed interest rate. But if the current interest rate is more than the guaranteed, which is like the current is like the interest rate that the general account is getting, the general account, because this one has nothing to do with variable. So so it's not separate, it's in the general account. Got it? So it's gonna give you whatever whichever one is bigger. During partial withdrawal from a universal life policy, what portion will be taxed? We talked about it. The interest, exactly. But it's never the case, bro. These policies never grow past the cash value. All of the following are true regarding a decreasing term policy, except all of the following are true regarding decreasing term. Remember decreasing term? What decreases? What decreases and decreasing term? D. A payable premium amount steadily declines through. No, the premium stays the same. Oh, yeah, well, it's except. You're right, bro. Because it's saying which of the all of the following are true except, so that one is false. Good job. In term policies, what happens to the premiums throughout the term of the policy? Hmm? Yep. Job. Which of the following statements is correct regarding a whole life policy? So, so whole life policy, cash value is not guaranteed. It is. The death benefit may increase or decrease during the policy period. Nope, it stays the same. Whole life policies is level death benefit. It always stays the same. The premiums is based on attained age. No, the premiums are leveled. The policy, ahí está. Process of elimination is D, right? The policy owner is entitled for policy loans. Yep. Wait, following statements is correct. Yep. Okay, there it is. Cash value is guaranteed. It's not guaranteed. No, it is guaranteed. It's going to equal the face amount when you turn 100. Make sense? All right. Which of the following policies is characterized by a provision where the premiums are lower in the early years of the policy and increase over time to a point where they become level for the remainder of the policy?
Pretty good.
Hmm?
Pretty good.
Yep. That's right. There you go. We talked about that one. Which of all life insurance policies is designed to cover two people and pay benefits after both die? Yep. Good job. An employee will be taxed on the cost of group life insurance paid by the employer if the amount of coverage exceeds. Dude, you're gonna kill this. You're ready to take the test, bro. We might as well get you to take the test now, to be honest. I wonder if that's possible. Oh no, it's not possible. It's 30 minutes before the exam. An employee will be taxed on the cost of group life insurance paid by the employer if the amount exceeds what? There's a rule for group insurance. 50,000. So just remember that, okay? Group insurance, 50,000. Group insurance, 50,000. Just like whole life, age 100. Whole life, age 100. So just remember right here, you see group insurance, just remember the number 50. They could ask it to you anywhere. It's gonna be 50. It's always the same damn question over and over. Which type of life insurance policy generates immediate cash value? Immediate cash value. This one you're gonna use a little bit of common sense, okay? And a little bit of extra like mechanics of immediate cash value. Which of these would cause an immediate cash value? Growth. What do you think? So beautiful. Catch up, dude. All right, here it is. Ready? The answer is single premium whole life. Why? Just think about it, right? If you put in a big old lump sum of payment, you pretty much have cash value ready to
Yeah.
go, right? Yeah. So decreasing term does not have cash value, so you could pretty much cross that one out and decross it out. Continuous premium, bro, they just made it up. They don't. By the way, when you're taking the test and you see something like that right there, continuous premium, you're like, "Oh crap, never heard of that. Dang, I didn't know that was going to be on the test." Most likely, they just made it up, bro. Just ignore it. Just literally straight up say, that's probably not the right answer because I've never heard of it before. Because I pretty much have told you pretty much like what's going to be on the test. Which of the following is a key distinction between variable whole life and variable universal life policies? Key distinction. All right, C, variable whole life is a guaranteed death benefit. Yeah, pretty much. You're right, bro. Good job. One of the advantages of family life insurance policy that provides coverage for children is that it what? Okay. Covers children for free, may be converted to permanent life policy without requiring evidence of insurability. That's the answer. So they get a per term and they could convert it to a whole life when they turn, I think, 21 or wait, let's see. Children cover family convert their term permanent coverage without evidence of insurance. Okay, I guess whenever, you know. Okay. Let's see. Which of the following is true about credit life insurance? Remember credit life? What do you think about credit life? What do you know about credit life? Okay. Credit life. Creditor is the insured. Creditor is the insured. No, the insured is the debtor, right?
Yeah.
Debtor is the annuitant. This is not an annuity. It's a life insurance. You could cross that out. Debtor is the policy beneficiary. No, the debtor is the insured. The beneficiary is the creditor. Creditor is a policy owner. Yup. Creditor is the beneficiary and the policy owner, so that the debtor doesn't change nothing. Any questions on it?
Well, this is weird that you pay for a policy that the creditor is the owner on.
Yeah. Well, the thing is that the debtor is willing to do that because he wants to borrow money. He probably needs the money, so he's desperate to comply with anything that the creditor says. The creditor says, "You're good. I mean, you got good credit, you got good income. I know you'll pay. It seems like you will pay. You have a good credit history, but I need you to get a life insurance policy." And the creditor and the debtor's like, "All right, whatever, whatever. Just lend me my money, just lend me your money." So that's why that works that way. And also the other reason is because the policy owner can change the beneficiary. The policy owner could change the coverage, the payment, the beneficiary, they could change anything. So so obviously they don't want the debtor to be the policy owner because then they're going to change the beneficiary to somebody else.
Makes sense.
Let's do it one more time and then I think you could take the test, bro. Let's do it one more time and take a little break, okay? Let's kill it right here. Let's go to the quiz. But you're getting a lot of them, dude. You're gonna pass it, bro. You're gonna totally pass this thing. This is a done deal. All right. An insured purchased a life insurance policy. The agent told him that depending upon the company's investment and expense factor, the cash value would change from those shown in the policy at issued time. The policy is a what? Mm. So it's not term because it's talking about cash value. Credit life is term, so now you're down to B and D. This one, I didn't really talk about it, so I'm just gonna give it to you. It's you're just gonna have to remember. Yeah, you're just gonna have to remember that, bro. Well, you seem to have a really good memory, so
Yeah.
I think you'll catch on to that. Interest sensitive whole life is that it depends on the company's investment and expense factor. An insurance policy that only requires a payment of premiums at its inception provides insurance protection for the life of the insured and matures at age 100. So it's a whole life for sure. So it's not D because it's age 100, right?
Inception, the start of it, right? Inception.
Inception is since the beginning of it. So it's one big payment. One big payment. Yep, single premium whole life. Bam, there it is. You got it. And increasing and decreasing term policies, which policy component fluctuates during the policy term? It's talking about term, so you can get rid of A. See that?
Yeah.
Yes. Yes. Good job, bro. Death benefit, or what's another name for death benefit? Another name for
Cash
death
value.
benefit. No,
Face them up.
face amount. Bam. Good job. Face amount. Let's see. Four, which of the following types of insurance policies is most commonly used in credit life insurance? Credit life insurance.
Decreasing. Or no, that time.
Credit life decreasing. Yeah, yeah, good job because the face amount decreases. So yeah, that's your gut instinct. Go with it, bro. Like if your gut says decreasing, just run with it, even if you're not sure. Your gut is probably right. If an agent wishes to sell variable life policies, what license must the agent obtain? Yep, securities license. And who's in charge of the securities license? Governed by what? The SEC. Remember we talked about that? So the variable products, which is you need a securities license, is governed by the federal government. Your life license is state, but the securities license is federal. through the SEC, and you need a securities license. Who monitors the securities exam? FINRA. The word FINRA. FINRA. And that I do have over here. Um, FINRA. Right here at the bottom. Oh, I guess I don't. Is it over here? Just so you could catch a visual, man, because sometimes it helps. Immediate, risky right here. See that? Variable annuity, separate account, securities license, FINRA, SEC. SEC is the government. You need a life license, so that's a state. FINRA gives you the securities exam to get your securities license. All those words are in the test. Separate account, risky, securities license, FINRA, SEC. Anything that has the words variable, variable products. Which of the following is correct regarding credit life insurance? Any word on that? It ensures the life of the debtor. Yes. It purchased an installment basis. Uh, yeah, kind of. It has a maximum of 20 years. Nah, there's no maximum. It ensures the life of the creditor.
No.
No. And you're just gonna go with that one because B is kind of weird. Installment basis. All right. The type of term insurance that provides increasing death benefit as the insured ages is called what? Type of term. So the death benefit goes up. So that means increasing what? Increasing term. Keep it simple. See that? So increasing term. Let's see if we could do this visually. There it is. Increasing term. What goes up? What increases? The face amount. And on decrease, and then we have the other one, right? Decreasing term. What decreases? The face amount. Graded premium whole life policy premiums are typically lower initially, but gradually increase for a period of 5 to 10 years. After that period, the premiums will what? Yep, that's right. Good job. For variable products, underlying assets must be kept in a what? Yep, simple as that. You got it, man. What type of premiums do both universal life and variable universal life policies have? All right, it is. I'm gonna give you a tip. Universal life. Remember, I told you what is universal life also known as? So the answer is flexible. All right, so this helps out a lot with universal life. It's also known as flexible premium adjustable life. All of the following are true regarding the convertibility option under a term life insurance policy, except convertibility option. So you're converting a term to what? To a permanent, a whole life. Most policies convert. Yep, that's true, but we're looking for a false, right? Upon conversion, the premium for the term policy will be based upon the attained age. Yeah, actually, yeah, that's true. That's true. Upon conversion, the death benefit of the permanent policy will be, that's not true. The coverage stays the same. Evidence of insurability is not required. Yep, that's true. They're just converting it. You don't have to qualify. So it's C. Which of the following determines the cash value of a variable life policy? What is it? Remember, variable is separate account, so it's definitely not C. You see that? You get rid of C. Policy guarantees are variable products guaranteed? No. So you could get rid of A too. The performance of the portfolio. Yep. Performance of the portfolio in the separate account. They're not adding it there, but I'm just gonna throw it in there just so you could remember. Bro, you're so ready to pass this test, dude. The other stuff is vocabulary, and I told you to watch these videos right here. Where is it at? Right here. Section 2, watch the vocab videos. Um, that's the other sessions. Like if I go to um right here it says which of these sessions, right? So right now we went over types of policies and the individual life insurance contract. We killed two exams on each, which is exam 4 and 5. Annuities, you learned everything about annuities. That's 8 questions on the test. Basic insurance concepts and principles, there's 9 questions on the test. That one is basically the vocab, bro. It's just vocabulary stuff. All right, we're gonna go over it a little bit right now. Um, Here, let's go over it real quick.
Like,
Okay. I'm just gonna go get into it. All right, insurance, bro. So insurance is a transfer of risk. People buy insurance to transfer risk. It doesn't eliminate risk, it just transfers the risk. Risk is the uncertainty or chance of loss. It's uncertain, right? Risk is uncertain, and it's a chance that something's going to happen. A person, a person is somebody. Person is like like it's not just a real person, but it's an organization or a corporation or association. A person is anybody, so it could be not just a real person. What's a real person in the test? It's called a natural person. A natural person is a human, okay? An individual. But in the test, it's called a natural person, okay? If they say just a person, it means all these things, okay? That's vocab. Indemnity. Point these two out. Indemnity is to bring back to normal. To indemnity is basically is what insurance does. You it was like that. It was like that, but you broke it like that. We're just gonna get it back to that. So if that costs $30,000 loss, we're gonna give you $30,000. So that's indemnification. Okay. So it says one party is restored. That's words that they use on the test. They restore. So indemnity, indemnify, to restore, to make whole again. A good way to remember that one, because it's not a word you use every day, is huh? Oh, you already did? Oh shoot.
one party.
There's a
The
word
original before the loss occurred.
before the loss occurred. Bro, you're gonna freaking pass this test. You're gonna kill this test, bro. Pure risk, speculative risk, right? Remember this? So pure risk is there's no gain, there's no chance of gaining, only loss. And speculative risk is like the casino. You could win or lose. So you can't insure it. Peril. Peril is a cause of loss, right? Peril, cause of loss. So right here, what caused the loss? The tree. Right here, the cause of loss? The storm. Right here, what caused the loss? The fire. Right here, what caused the loss? The hurricane. Peril. All right here, this is good. Life insurance is to create an estate. Annuities is to liquidate an estate. Liquidate means you're cashing out, right? But life insurance, if I die, my wife gets immediate estate. Make sense? Face amount, death benefit, same thing. We talked about that. Hazard. Hazard is a condition that increases the chance of loss. So risk is the uncertainty of loss, ¿verdad? But hazard is something that increases the chance of loss. Like a health issue, that's a physical hazard. Morale, perdón. Morale means I don't care. Moral, no, sorry, the other way around. Moral means I don't care. Like I'm gonna lie to you, morale. Sorry, dude, I'm jacking this up. I actually had it right the first time. Morale means I don't care. I'm indifferent. Who cares? I'm reckless. I don't give a crap. But moral is I have bad morals. I lie a lot. Yeah, you have bad character, exactly. Oh, forget that I have a word.